So roll call will be Mayor Brown is out, Director Harris is also out. We have Jay Ellington,
Here.
Dara Cornett,
Here.
and Tree Banks.
Here.
Okay, we do have a quorum. And then the next item on the agenda is the approval of the last meeting's minutes.
I'll entertain a motion and a second.
A motion to approve.
Okay. All in favor?
Vote.
All opposed? All right, and then the third item is a presentation by GRS. If you can come on up. Yes, thank you.
Good afternoon. Again, my name is Tom Bevins. I'm with GRS. We do actuarial consulting for the TAPERS plan. We do an actuarial evaluation every year. It is a little bit later for us to present than typically. So the numbers are somewhat, you might say, stale in terms of timing, but the message in terms of the plan is still valid. So we want to go over the summary. Our evaluation is basically a snapshot of where the plan stands as of July 1st, 2022. So at that point in time, again, some things have changed in the last several months, but at that point in time, the valuation showed that there was some unfavorable asset experience. And when we say unfavorable, we mean the asset, it's in relative to our assumptions. So the plan assumes 5% return every year, and the annual return as of that date was negative 10.33%. Again, that was probably the, I guess, peak loss timing. So some valuations that are, we might do a valuation as of December 31st, and that annual return looks much different. So it does vary throughout the year, depending on whether it's a June valuation, a December valuation. But this plan does a June 30th valuation. So when we say there was $392,000 less in assets than expected, so there was an expected return of about $130,000. The actual dollar amount loss was $261,000. So expecting a positive gain of 5%, getting a negative gain of 10.33% is an aggregate dollar loss of $392,000. And then we also are looking, now we don't, again, we don't manage the assets. Again, we just take the basic data and do a money-weighted calculation on the returns based on beginning of year assets, end of year assets, and all cash flows that come through, benefits paid, contributions made, and expenses, et cetera. We also, what we do as actuaries is we measure the liability. And again, the liability is the present value of accrued benefits. Throughout a retiree's liability is fully accrued. They've completed, they're in payment. It's an accrued liability. For active employees, the accrued liability is kind of based on their service up till this point. So there's the total present value of benefits as being a piece of pie. The active employees have accrued so much percentage of that pie. When they retire, they've completed that pie in terms of their full liability. A liability loss, again, is in relative to our assumptions. So when we talk about a $68,000 demographic experience loss, that just has to do with, if the assumptions are that X number of people are going to retire and only Y retire, then there's a liability gain or loss based on that. And the same goes for any other what we call decrements, which are just ways that people come in or out of the plan. And so $68,000 as a liability loss is not a relatively large number, so actually that's a good thing. One of the big things based on the asset losses is the decrease in the funded ratio decreased from 35.1% as of the 2021 valuation to 27.2%. Meaning that the assets in the plan are covering only 27.2% of the liability, again, of the accrued benefits. This is something that we've discussed over this past several years, just in terms of, it's been on this trajectory for quite some time. The city has continued to try to increase its additional appropriations. And we talk about an unfunded liability, meaning the difference between actual assets and the accrued liability. That is the unfunded liability. And because the plan is highly mature, closed plan with only few actives, the plan is not going to be receiving many contributions based on member payroll. A fully active pension plan that is continually open to new employees is continually replacing that payroll base to make those contributions to the plan, whereas this is a shrinking payroll base. And so in order to be able to catch up to the unfunded liability, the city has been needing to make those additional appropriations beyond payroll-based contributions. And a few years back, for a while there was no additional appropriations. I think when the plan closed, I want to say there was roughly 40 active participants, and now we're down to 10. I believe it was kind of 40 actives, 40 transition participants, and now we're down to like 10 and 13, or that's on the next slide actually. But what was made during the plan year ending July 30th, 2022 was an additional $200,000 in appropriations. Based on those, if those appropriations continue, based on all assumptions being met, it is projected that the plan would be depleted by the year 2031. Just as some alternatives, and I'll show some graphics with that later, if the plan were to no longer make additional appropriations and rely solely on investment returns, which again is a shrinking amount of leverage on the assets, and just the payroll base that is shrinking, that expected depletion date would actually be is projected in 2027, which is, seemingly right around the corner. What we'll talk about as well with some graphs is we also calculate, how much is it really going to take to put this on a trajectory to be fully funded, to have no depletion date? And we use we're using like a 20-year target. So for the plan, again, all assumptions being met, for the plan to be fully funded in 20 years, we would say that the minimum requirement, it would be an additional $490,000 in payments. And we'll talk about a little bit how that's being covered, because based on how much benefits are being expected to be paid as well by current retirees. The next slide 3 in the presentation, is just some of the demographic metrics. Again, as of the 2022 valuation, there were 10 active participants, 13 transition being employees who were part of the plan as of the plan closure on June 30th, 2012, that were not fully vested, meaning they did not have 10 years of accrued service at that point in time. 33 retirees and beneficiaries currently in payment, and 30 inactive participants that have terminated service but have a benefit payable upon retirement. The annualized covered payroll, again, is that number is continuing to go down because of the decrease in participants that are covered, because those are only those people that are under the line item of active. And so the employer contributions, so the $200,000 was made as the extra appropriation. The remaining $647 was the payroll-based contributions, and then the $9,529 came from the members themselves. The benefit distributions during the plan year, again, the year ending June 30th, 2022, is $631,000, and of that amount, roughly $260,000 of that were lump sums payable to retirees, or I believe there was also included a member death was included in the lump sums. So that leaves roughly $372,000 in monthly annuity payments. So when we do the evaluation, again, we look at the liability, the accrued liability of the plan, again, the accrued benefits, present value of those benefits. The liability is $7.9 million. The assets currently at $2.1, $2.2 million. So that leaves an unfunded liability of nearly $5.8 million. Again, that liability is not benefits due today, that's the long-term liability of future benefits. And then we talk about an annual cost. The accounting column is more for kind of like the, required city disclosures and its financial statements. So there are some major differences there. From our standpoint, we're looking more from the funding perspective. Again, although we do provide these required numbers for the city for the accounting basis. The reason the liability is so much bigger on an accounting basis is entirely because of that discount rate. And the discount rate is what we use, a blended discount rate between a municipal bond rate. Basically, when the plan is expected to be depleted, it's now paying out of city funds. We assume the city would have to use bonds. We use a 20-year bond rate. So there's a blended discount rate between a bond rate earning 3.69% and the assumed investment return assumption of the actual trust of 5%. The annual cost is the one that's the most confusing on there. How can the annual cost be negative? And again, that's from an accounting standpoint, and that because the plan is mature and closed, the change in the discount rate from the prior year, changing from 2.13% to 3.85%, that single discount rate change, the higher the interest rate, the lower the liability. And so because it increased, since the interest rate increased, the accounting liability decreased, and from an accounting standpoint, gets to recognize that immediately. So that's why that number there is basically what we call the pension expense from an accounting standpoint. But the annual cost from a funding basis is what we call, that's a sum of the normal cost. The normal cost is the amount of accrual of current employees. They haven't accrued their entire liability, so the normal cost is the amount of increase in the accrual towards their benefits to where they basically complete that pie of their total present value of benefits. Plus administrative expenses. And the biggest portion of that annual cost is the amortization of that unfunded liability of $5.8 million. So you'll think of that as what is the payment, like a mortgage payment, to pay off that $5.8 million in 20 years. So those are some snapshot metrics. More importantly, with this case, with the TAPERS plan at this time, is where is the plan heading, and what does the city need to do in order to manage that? This is just some history of the unfunded liability, like how much is the unfunded. Essentially, we want that unfunded liability to get to zero, meaning that the plan has all the assets it needs to cover the future benefits. Generally speaking, a normal plan may have a trajectory that does increase over time and then eventually comes down. But you can just see, I just pointed out a few things of why there's some zigzags in that line. The big jump a couple years ago were assumption changes. That's because we lowered the investment return assumption from 6 to 5. Again, so by a lower investment return assumption means a higher liability. That's why it jumped up. But then that next year, there was actually very large investment returns. So that helped take away the chunk of the unfunded. The investment returns covered a lot of that unfunded. But then this last year, that negative 10.3%, that was a actuarial loss on the investments. And so that's why it jumped right back up. So just comparing, because of those changes, the red dashed line just shows the trajectory last year, knowing last year, the year prior, the city was accounting, including $100,000 of additional appropriation, and then the dashed blue line being the current funding of $200,000 extra appropriations. Again, as said before, it is projected to reach a point where the funds are exhausted in the year 2031. So just a comparison of, on the next slide, slide 6, a comparison of liability and assets kind of on the same graph. Again, just trying to provide different visuals here. So on the current trajectory, as you see, the blue line, the dark blue line, assets are expected to be depleted at its current course in the year 2031. That recommendation of 490,000, this shows the difference that trajectory makes. The assets will exceed and catch up as the liability. The liability is now in a position where it's projected to decrease over time because of the shrinking population. We're not getting new employees, adding new liability every year. So it is now at a point where the liability is on a downward trajectory. And so trying to meet that point where those two intersect is where the assets equal the liability, and therefore the plan is considered 100% funded. Again, one of the things I wanted to note on this is there's a metric, and it's in our report, in a section where it shows the cash flow as a percentage of assets. Now, it is normal for a mature plan to have a negative cash flow, meaning more benefits and expenses are going out than contributions are coming in. But those cash flows don't include investment returns. So it is normal for a very mature plan, but currently, more recently, the plan has had cash flows of negative 14% and negative 23%. Those are very large negative numbers, meaning there's a lot more going out than coming in, and so that is why the fund is on a downward trajectory. Because the investments, investments returning 5% can't handle that deficit. Slide 7. So what happens when and if the plan is depleted? There are no longer funds in the trust fund. The city is obligated to pay those, kind of what we call a pay-go, a pay-as-you-go plan. That's quite common when you look at retiree health care benefits. If the city has a retiree health care benefit plan, a lot of those plans are paid as what we call a pay-go. They're paid out as just normal city funds. There's no dedicated trust. And the pension plan would essentially become just like that. So, like noted before, the actual annuity payments paid out were roughly $372,000. In addition to the fact that there tends to be some lump sum payments almost every single year, there's projected benefit payments anywhere from $400,000 to $600,000, could be more now that we have in a situation now where we have half of the active employees eligible for an unreduced benefit. 5 of the 10 people are currently, I'm including an additional person that's not considered active, but there are 5 people that are currently eligible to retire with an unreduced benefit. They could take lump sums worth roughly $1 million, which is almost half of the current funds. So that's just something the city has to be prepared as a possibility because they are eligible. So what happens is the city would no longer be able to rely on the funds to pay those benefits. It has come directly out. So the recommendation of the additional appropriation is just kind of getting a head start. In a way, it's kind of covering the benefits already being paid due, which gets us closer to not having that negative cash flow. We had the negative cash flow. If we can eliminate the negative cash flow or minimize that negative number on the cash flow, that allows for the investments to have some sort of return that can, over time, build up to catch up and be able to pay those benefits long term. I won't go in too much detail on the next 2 slides, just a different way of looking things in the table. I just will give a quick overview. The first 2 just show the left is the recommendation, the actuarial recommended contribution to be able to get the plan fully funded within 20 years. That is the $490,000 annual appropriations. So, you can see that over time, when it gets to flat 490, basically, in 10 years, it's basically expected to to just be those appropriations, because that basically is saying that in 10 years, according to assumptions, there would be no more active employees. So there would be no more payroll-based contributions. Now, again, that's just based on assumptions, because we have an assumption that is, once they're eligible for unreduced retirement, we assume that they do retire. That doesn't mean that there won't necessarily actually be some remaining employees at that time. Table 2 is basically what is currently going on. So again, even though that is definitely helping extend the solvency of the plan, there's still an expected depletion date in 2031. Just to show the difference that makes, if no additional appropriations are made, then that could happen as early. And again, when I say as early, it could be earlier. This is assuming everything, all assumptions are met, which never actually happens. It could go either way. It could be, based on all those assumptions, could be 2027. That's the relative difference. And then the last table is to show basically what's the next step. Maybe the city still can't budget the 490. Can the city continue? The city had none for a while, then they went to 50,000, then they went to 100,000, and now they're 200,000. What's that next step to getting to that fully funded strategy?
Hey, Tom.
Yes.
For 2023, we've increased our contributions an additional 50,000.
Okay.
Up to 250,000.
Okay, that's good to
So we'll
know.
continue to see increases.
Okay, so, and we'll look at that and how that would change. And so you could kind of find that middle ground. You could, again, if you can sort of somewhat interpolate, it's not completely linear, but if you were to kind of compare tables 2 and 4, that would be somewhere in between. Again, so just in conclusion, in slide 10, the message hasn't really changed over the years, that the additional funding, the extra appropriations are needed to keep the solvency of the plan. The city has continued to incrementally increase that, which has always been a good sign. And we still want to continue monitoring that and increasing that as much as possible. Again, we're going to recommend the 490, and whatever the city can do to get close to that is going to be the best interest of the plan. And that's essentially the end of my presentation. If there are any questions, I am open to those questions.
So the 490 actually projecting out carries it how far?
That's essentially forever. So the 490, again, it's fully funded in 20 years. So there might be a number less than 490 that would keep it in an upward projection, but it may take longer than 20 years to get fully funded. So I did not come with a break even for what is needed to just have a level where it's not going to, maybe take 60 years to be funded, but it's still not going to be depleted.
Can you send me that information, what that break-even point would be?
Yeah, we could probably look at that. Yeah, we could just kind of, so it's obviously going to be somewhere between 300,000 and 490, because the 300,000 still gives us the depletion date. So we could probably do that calculation pretty quickly.
Thank you.
Mm-hmm.
So the question for the city might be whether to continue raising to try to get to the 490 versus letting the plan get to zero on the cash flow side and then paying that premium every year, okay?
Right, because I guess at the end of the message is, if the city can't budget 490, the problem with that is if it gets depleted in those 5 to 7 years, it's going to be a lot more than 490 in benefit payments. It's projected it could be $650,000, $700,000 just in benefit payments. So, at that point, the city has to pay that. So, so the question is, can it get that head start? how much of a head start can it get so that we're not jumping from whatever it's paying to being obligated to pay anywhere from $600,000 to $700,000 a year just to meet basic payments.
Sure. I'm just saying, most of us local governments can't come up with those extra dollars.
Right, yeah.
And would rather face that big payment out here 10 years down the road rather than having to try to get there.
Sure, no, I understand, yeah. So, again, I'll provide that break even to maybe see like this kind of some would call it a break even, some would call it a, treading water.
Right, so we're obligated for it. We know that anyway.
Right.
Okay, that's not a problem for us. We know we're gonna have to pay it
Okay.
at some point
Sure.
in time. Just a matter of making our operational cash flows work on our side as well, too.
Understood.
And if I could push that off 10 years to somebody else's problem, I'd probably. I'm just playing with y'all.
Understood. And like, we've known that this has been something that, the
Sure.
city's been working for. And again, making progress. I don't want to take away the fact that the city has made progress by making those incremental changes. So, there is something to the fact that we understand the city's doing what it can to make those incremental changes, and that should definitely be applauded.
Sure, and I understand recommending actuarially that we need to be at 500,000.
Right.
I understand that, but for us, getting to 500,000 is a different story, okay?
Right.
It may take us years to ever get there,
Yeah, understood, yeah.
which continue. We know we still have that big obligation out there.
Right. And like I said, our job as actuaries is just to give you those metrics so that you understand that, what numbers get you to what point in time. And
Right.
so obviously we can't make those budgeting or understand necessarily all the, conditions that the city is dealing with. Thank you.
Good, thank you.
All right, up next, we have a presentation from Bank OZK, Jeff Dixon and Ryder Pierce, sorry.
Good afternoon, Mr. Chairman and members of the committee. My name is Jeff Dixon. I'm the Senior Vice President in charge of retirement plans for Bank OZK, and it's a privilege to be here with you today. Tom's kind of a tough act to follow. That was quite a presentation. It's a tough situation you've got right now with trying to bring this plan into funding, and we're proud to do our part. We actually came on last summer, so we start kind of where his presentation ended, I guess, or really a couple of months after that. But just the first few pages, does everybody have a copy of my handout? The first few pages just shows you the team that you are working with. When we met last summer, our Chief Investment Officer, Minnie Mills, was there. Minnie retired March 3rd of this year after a long and distinguished service with Bank OZK and other places before that. And she will be missed. She did a great job, but she got things started with respect to this plan, and we've got a new investment manager that's taken over.
She must have had a fully funded retirement system.
She definitely did. And anyway, she sends her regrets for not having been here, but it was a privilege to work for Tapers for the short period of time that she did. Now, Bank OZK has served Tapers as provided administrative services for a number of years. Actually, for as long as for longer than I've been there. I've only been there since April of 2020, and we had been serving administrator for long before that. But there's my bio. If you have questions or any questions about the plan or about the system and need to talk to anybody about that, feel free to give me a call. Ryder Pierce is our newest investment manager that has taken over the function that Minnie was providing. And previously Ryder was the chief investment officer at an East Texas bank, and he managed investments totaling over $1.7 billion, as you can see there on his bio. And he's going to talk a little more about economic activity and the performance of the fund since we took over. And if you have any, and he'll have more to tell you about that when he comes up. Some of you also work with Angie Bobley, my assistant. She processes distributions for the plan and provides other types of assistance. And incidentally, the city's to be commended for increasing the contribution again this year. That's a great step, and hope that it can continue to get closer to that goal that Tom has set for getting this system fully funded. And I spoke to some of you earlier today, also with a different pension. Banks have been in the news a lot lately. I just want everybody to know that Bank OZK is one of the best capitalized banks in the country. In fact, there's a little information about the bank in the first few pages there of my presentation, and you can look at it at your leisure. But just one thing. One service, S&P Global Market Intelligence, as of December 31, said Bank OZK is the #1 capitalized bank in the country. We have used a safe and conservative strategy. Our bank has done very proud of the work that our bank has done to stay strong and stable over these years. Since we've been, well, just with respect to the administration of the plan over the last few years, we've processed pension payments of $30,523.52, had some insurance holding of $624.33, and then we made distributions total. We've had total participants of 33. So unless anybody has any questions about me or about the administration of the plan, I will go ahead and turn it over to Ryder Pierce. He'll talk a little more about the performance and about the economy in general. Ryder? Oops.
Thank you, Jeff. Thank you, Tom, and those who came before. Some of you I had the pleasure of meeting earlier. Those I haven't, my name is Ryder Pierce. I've been at Bank OZK since December of 2022. I was working for Southside Bank in East Texas, and ran portfolios for them, and then had just got promoted Chief Investment Officer in fall of last year. And had sold our house, put it on the market, and I think it closed in 3 or 4 days. And not 3 weeks before closing, Bank OZK called and asked if I wanted to come back home. So, with 2 little ones, we found us a rental house in Little Rock with 4 days to spare, and are very happy to be on board. I've had the pleasure of working 3 months beside Minnie Mills before she retired, working in client meetings and appointments, getting to know her clients and the good work she had done, got to see all of the congratulations, and I'm just happy to be on board and to carry the legacy that Minnie left. I try not to sit in the shade of trees she planted, but it's hard when she planted so many trees. So today I'm going to talk to you a little bit just about a brief economic background, and I know some of you have, no, it's fine, we can do this. I know some of you have seen this, but for those who haven't, you deserve the full rundown. So I'll just start from the top and we'll go from there. If you look at the cover page, after I do this, we will review performance in the account, then I add any time if you have questions. Please stop me, feel free to ask. I can move a little quick, and I'll try to slow down and not get too caught in the weeds here. So the first page off the cover page, and these are not numbered because it was a 40-page slide deck we put together, and we've kind of chopped our favorite 14 or 15 slides today for the sake of time. Page 1, we look at U.S. economic growth, specifically GDP, or gross domestic product. On the left, you see that the historical trend rate for GDP growth has been around 2% annually, or 2.0%. Recently have fallen under that after clawing back post-COVID. You can see the percentages quarterly there in that little table above the chart. What is important is the Fed has came back just recently in their recent meeting and adjusted their projections from GDP growth to 0.7%. This is real GDP net of inflation, 0.7% in 2023 and 0.9% in 2024. So they do expect us to be below trend growth going forward in the U.S. economy. On the right, you see the components of GDP. And I mentioned in the previous meeting, I'll mention again, that, if anyone in here took basic business classes, this is your C plus I plus G plus N minus X, or the formula for GDP, and then the biggest piece of that is consumption. And I just point that out because I think sometimes that as we had a brief recession last year by definitions, and as many economists predict a recession going forward, that the biggest part of our economy is consumption. And recession begins at the worker level. It doesn't begin at the top with companies. It begins at the consumption level with workers and with our citizens and their spending. So it'll be interesting to see how that flows through the economy as rates continue to put pressure on margins and put pressure on wages. And I say wages, meaning real wages, because if you turn into the next page, we have a chart of the U.S. unemployment rate and wage growth. The light blue line shows wage growth, the dark line shows the unemployment rate, and if you can see there, we are at the precipice of historic unemployment levels. Now, we can make arguments on the labor participation rate being a little lower than history, but we are currently sitting today at a 3.7% unemployment number or unemployment rate. All of these numbers that you're going to see in this chart are going to be end of year 2022. So they're a little backdated, but they match the fact that we are kind of looking at an annual report here. This is current unemployment levels are in the Fed will say they expect around 4.5% by the end of this year. We will see a spike in unemployment this year. This will not stay forever. If you look in the past, below 4% unemployment has been unsustainable in the long run. Please turn the page again. This has been on the top of my mind because I recently moved and sold a house and am facing some of these challenges in my home life, and that's the housing prices and affordability. So what we understand in the present value of an asset is that it is purely a discounted, it's all the future values that asset, all the future cash flows that asset has discounted back at a certain interest rate. Well, over the past year, that interest rate has changed dramatically. However, we've not really seen a change in housing prices too much, at least not in these areas. Now, coastal areas maybe, but more flyover states, we've not seen a massive decrease yet in housing prices to reflect. So let's say mortgage rates go up 1%. The cost to own the same home effectively goes up 8 to 10% at a purchase price level. So what we see here is that a lot of these increases in rates have really stressed the home buyer. In the bottom right corner, you see the credit score at mortgage origination. The people buying homes right now are of a higher credit quality than we saw 2008, 2009. That's what have led a lot of economists to say that they do not expect the same type of housing crash we saw in 2008, 2009. If you continue to turn the page, on the back there, you show on the top left corner housing inventories, and the top right corner single family housing starts. So not only do we currently have a situation with shrinking inventories, we also have a situation where post-financial crisis, people are not building homes at the same rate that they were, and it's finally catching up to the U.S. economy. So this doesn't necessarily apply, but while we're reviewing the economy, I think it's important that we all understand kind of the I don't want to say housing crisis for overusing, but the affordability of a home in the United States is the most difficult that it's been in the history of our country, really. You turn the page one more time, we'll look at the U.S. dollar. Now, this applies to our economy because it affects our trade balances with our trade partners, both imports and exports. U.S. dollar peaked last year somewhere around 112, and that's on the dollar index. I won't dive into what that means. If you look at the bottom right corner of this page, you can see the interest rate differentials. Now, this is the difference between our treasury rates, 10-year yields, and international as an aggregate yield. So what happens here and what drives the dollar up, just for the purpose of education, is that our rates become higher than countries around us. Those countries would much rather invest in our interest rates. So that tends to drive the dollar up, which then makes imports less expensive for us, but more expensive for our neighboring countries. Please turn the page one more time. We'll talk about oil. Oil is a buzzword in this part of the world. Mainly, I spent a lot of time in East Texas, 7 or 8 years around that economy, both in Tyler and Lufkin, Texas. You're in Texarkana, Arkansas. You're not far removed from oil being a large percent of the economy around here in jobs. So it began the year somewhere around $80 a barrel. Today it's trading at $66 a barrel. So we've seen oil really fall off in the past month, not applicable towards the end of 2022. We all understand that oil is a highly volatile asset. I do want to point out that in 2020, I don't think anyone would have ever foreseen a situation where we saw oil futures trading at negative $40 a barrel, essentially that would pay you to buy oil in 2020. There was a sliver week or multi-day situation. So as we look at oil and how that carries over to consumer costs and then carries into inflation, we do see oil to be relatively volatile going forward. And then the big elephant in the room, if we turn the page one more time, and that's going to be your U.S. Treasury rates or your interest rates. So what happened in 2021 is the Federal Reserve essentially came out and they said they believe that inflation is transitory, and transitory became the buzzword on news, in different announcements and in periodicals, journals. However, it's proven not to be, and I think what we found is that inflation is this big snowball that once it gets rolling down the hill, it's very difficult to contain. So what the Federal Reserve has come out, and they've been very clear in their communication that they're going to do this, and you'll see that our reception of the Federal Reserve's communication in your portfolio construction. But the Federal Reserve came out and they said, hey, we're going to raise rates, and they continued to say, hey, we're going to raise rates to fight inflation, and people continued to bet against them, and I say people, banks, and investors. Now we're in a situation where if you look at the Treasury curve right here, the dark line on the bottom is what rates we're at for each of these time periods or maturity periods at the end of the year 2021. The blue curve above is what each of these maturity periods rates were at 2022 end of year. That is the largest increase percentage-based that we've seen in the history of the U.S. economy. Essentially, the two-year Treasury went from 0.73 to 4.73. So times 5,000%. Never seen something like that. Just for reference, it began the month at 4.9. Fed funds rate continues to climb. So the Fed is doing everything they can to fight inflation. We'll talk about that, what that means for your investment portfolio in a minute. Thankfully, many set us up to take advantage of a situation like this. So that being said, something else I'll point out, I didn't point out in the last one, you can see on this curve the 10-year and the 2-year. I want you to focus on the 10-year and the 2-year. Excuse me. And then on December 31st of 2021, the 10-year was 1.52%. The 2-year was 0.73%. So if you subtract, there's a very, very popular bellwether, economic bellwether called the 10-2 spread. If you take the 10-year Treasury at 1.52, subtract it from the 2-year Treasury, we're going to end up with about a 0.79 positive spread. Now, if you go up at the end of last year and do that, the 10-year Treasury was 3.88. The 2-year Treasury was 4.73. So you're going to end up with roughly a negative 0.8 to 0.85 negative spread. Now, that's important because history has shown us that the bond market tends to be the best economist we have. And never in the history of the U.S. economy and Treasury rates have we had a spread below negative 0.4 or a spread stay inverted, negative, meaning the 2-year being higher than the 10-year Treasury for longer than 4 months and it not indicated in an ensuing recession. So that which for years has been considered one of the largest recessionary indicators, is flashing at us. It almost went to 1%, or may have touched negative 1% last week, just briefly. All right. A few more pages, and we're going to get there. Please turn the page. This shows us our Bloomberg U.S. aggregate bond annual returns. Essentially, this is the U.S. bond market cap weighted for its exposures. You can see how the bond market performed each year going back to 1976. However, obviously the year of 2022 was more of a black swan event. That is the largest intra-year decrease we've ever seen in the U.S. bond market by far. And if you have your own personal portfolios that you manage, or retirement accounts, this has been the real issue. It's not been the decrease in the U.S. stock market, but we understand that goes up and down, and we'd like to all get 5% every year, but the nice thing about a 5% expected return is it smooths that volatility. You can average 5% and that volatility be a whole lot higher. And this has really changed the investment landscape, and this is also the reason that you're currently hearing about bank failures on the news. This tells that story to a T, and I can go on that as long as you would like me to, but I'll step aside from that unless anyone has any questions. Essentially, as bond prices have cratered at a level that we've not seen in 50 years, a lot of banks held long-term bonds that they also cratered, and the way that they accounted for them in their accounting system, they did not have to take those losses through their income statement. But they're there. They're real. At least they are right now. Furthermore, if you turn the page, you have the S&P annual returns. Also not a good year on the S&P. Intra-year return down 25%. End-of-year down 19%. Though the one thing that should point out to you is take a look at all those good years going back to, let's see, this goes back to 1980. All those years where maybe in the late 90s or the mid-2000s or coming up, you're still seeing massive intra-year declines. So in the event that we see the S&P 500 have a large intra-year decline, because it averages 14% a year, and it really hasn't had an intra-year decline yet this year, we believe that long-term investing should continue to be the strategy and the goal. It should be about what the client, in this case, tapers, what the client's goal is, which is funding their obligations, and that happens through sticking to a long-term diversified investment strategy. We're going to put these two together on the final slide, but let's see, we can turn, I'll skip the value versus growth breakdown. I kind of dove into that, but that can get a little complicated. Let's turn, so you have a page that says value versus growth, another one, value versus growth, corporate profits and sources of total return, and then finally asset class returns. Let's go right here to asset class returns, which is what we call a jelly bean chart, but it's a chart with all the squares and all the colors. Now, if you were to pick a chart, each of these represent a different asset class or investment style and category. For instance, it has emerging markets, bonds, real estate, but also the different large cap, small cap sectors of the U.S. stock market. If you were to pick a color and you were to trace one of those colors, it could be up, down, depending on the year. There really isn't a smoothed out color with consistent returns, and this is relative to its peers, no matter really where you look at. However, the smoothest option, or the most median option of all of those colors, is white, which is a diversified portfolio of those asset classes listed there. And we show that just to show you that, once again, hey, diversification works. It works. And if you look at the far right column shows you volatility. So up to that point, you have annualized return and volatility. The annualized return in an asset allocation diversified model is on the topper end, while the upper end, while the asset allocation volatility is on the lower end of all those asset classes. Once again, we just want to show that to you to remind you that diversification does work in the long run. And then the final page, and this is This is the elephant in the room, and this is what we've been talking about most with our clients, and that is the fact that in 2022, there really was no place to hide. The average 60-40, which means 60% stock, 40% bond portfolio, was down, the average being the S&P 500 and the Bloomberg Aggregate Bond Market Index, representing each of those categories, down 16% last year. You can only find 2 years going back to 1950 where it was worse. One of those was the financial crisis in 08. I don't know how many of you remember the financial crisis in 08. I personally, my family had a business. It was a very difficult time. Last year was not like the financial crisis. However, the reason that the diversified portfolio performed poorly relative to prior years was because of the pain caused by rising rates in the fixed income market. Now, I say all that about fixed income market to say that if you buy a bond at par, if you buy a $100,000 U.S. Treasury bill and you pay fair value for it at new issue, which we call par in finance world, so you pay $100,000 and it's a 5-year bond. At the end of those 5 years, you'll get back $100,000. What happens between point A and point B, if your goal is to buy and hold for a long-term investment strategy, should not matter. So, though this doesn't necessarily apply to the way that the TAPR's asset allocation is set up, it is important to hammer home that some of this fixed income volatility or fixed income decline will work its way out over time, as long as proper fixed income management kind of has been implemented. So, after that's the end of, I think that's the last slide on my economic summary. Do y'all have any questions? Feel free to ask. Just having this discussion coming off of all the news in the past week with banks and Silicon Valley Bank, it's been really interesting. Interesting time to have a discussion about fixed income declines, because essentially what they had was a book full of fixed income securities that had declined, and they were not marked down in value on their book. So they still had to mark it what they paid for them, but they were down 20%. And I'm just using rough estimates. Please don't quote me on this. When they had to get money for liquidity for people who wanted their money out of the bank, they had to then sell those securities, and they incurred a $2 billion loss by doing that. And so there are some banks that are having to work their way around that. It's easily researched who's got more of those securities on their books than others. Cool. I'll go to performance report. If you just turn, we have the main page. Let's just go one more time, get into the meat and potatoes, which is your asset allocation and your performance. As Jeff mentioned, I understand we took over this class, this account summer of last year. You see a breakdown right there on the left of asset classes. So cash, money markets, taxable bonds, U.S. equities, international equities. You have performance for 3 months, fiscal year to date, which is the last year as a whole, and then the reporting period. It says the reporting period is from September to 2020. I don't believe that whole reporting period applies to our management, but I'm not really sure it matters necessarily for the sake of reviewing. So if you look at taxable bonds over the last year, okay, hold on. One more thing I want to mention. I mentioned this in the last one. Our performance numbers are only good as good, and when we show you and talk about performance is the benchmarks we've selected. The most important thing we can do when we talk about performance is select appropriate benchmarks. That's what we measure against, right? It's how you know if you did well, because 5% return means nothing if your benchmark did 10%. Your benchmark for taxable bonds is a Bloomberg 1 to 5 year credit government. That is our default benchmark for fixed income at Bank OZK. However, it's probably not the most appropriate benchmark given the life expectancy of this account. But probably a longer benchmark is more appropriate, but we're going to leave it at the default here. Then you have the U.S. equities S&P 500, and then you have the MSCI EFA for international. Now, we'll just go year to date. Money market up 0.7, the benchmark was up 1.5. Taxable bonds, which is your treasury portfolio, down 5.5%, benchmark down 5.5%. U.S. equities down 18.4%, benchmark down 18.1%, international equities down 17.4%, benchmark down 14%. However, we do have a active underweight in international equities. I believe that's probably something that came over like this, is from looking at the history. We added some international relatively recent in the portfolio, but other than that, it doesn't look like a whole lot has been changed on the equity side. The blended benchmark class return year-to-date down 11.7%, the benchmark down 10.9%. For reference, though, if we just hone in on the taxable bonds section, the Bloomberg 1 to 10-year government credit is going to be down about 9%, give or take. We'll say 8.8 to 9.8%, depending on when it's measured from. And the Bloomberg aggregate bond market was down 14%. So being down 5.5% when all you were in is 1 to 5 year U.S. Treasuries, there were a whole lot worse places to be. And once again, total portfolio down 11.7%. I showed you on the previous slide that the average 60-40 portfolio was down 16%. Anyone have questions on performance?
Yeah, so let's
Let's
look
go.
at market value percentages again. I asked you this in the other one.
Please.
Same thing. We had a lot of cash and money market percent, or high, 17+ percentage. Probably helped us during this last turn down period a little bit, but is that not, I would like to see that a little lower.
So two of those,
Okay.
that's a good question. I have cash right now at about 3.5%. The other two, it says cash or equivalent, same question, right? Is the equivalents are 2 U.S. Treasury bills. One that matures coming up in April,
Okay.
one that for 100,000, one that matures in August for 200,000. So that 300,000 is technically in Treasury bills. It will be maturing. We will be looking at both diversifying out,
Okay.
not having 300,000 of a $2 million account in 2 securities. We will diversify that out a little more, but we're going to look at stretching the duration out further. Then that's what I came to about we were going to get to at the end was, some of the things that many did in the fixed income portfolio have really set us up to take advantage of these rising rates. I bought a 5-year CD yesterday at 5%. I don't know the last time, not in my career, has that been a possible thing. And it's been a long time since you've been able to buy a 5-year CD at 5%. So, as some of this stuff at lower rates, the opposite of what many could have done was took the 2.5 to 3% return that treasurers were paying last fall and gone out 7-8 years to get it. And now we'd be in a situation where that investment value would be down 12% or 14%. So there were some good moves made. The question is, where are we going further? And we absolutely will be looking at the appropriate, we won't want to, and I'm sure that the limited factor on these for what fixed income is allowed, but we will be taking no default risk probably, or very little default risk, and going out and capturing a good yield.
And so how often are you adjusting?
I will let these roll off, and I will buy as they roll off. I will not sell anything. There will be no adjustments made in fixed income. These will mature, and then will be bought out in pieces, probably based on the size of the portfolio, in pieces of $50,000 to $100,000. The Vanguard.
Are you just watching maturity dates, or what are you doing? And how often
So-
do you look at the investments in this account?
I look at it on an as-needed basis on the fixed income side, because this is I'll get an alert. There's no reason to go in and sell any Treasury bills, because a lot of that is priced in. Like, any changes in rates are automatically priced in Treasury bills. So I'll get an alert probably a week out to 2 weeks out that'll say, hey, Tapers is having a maturity, and I'll go out and I'll find, and I'll begin looking. Now, the reason I wouldn't do that any sooner is I could tell you I'm looking at it every week, but I'd be lying to you, because there would be no reason on this fixed income stuff. It's the whole purpose of laddering it out, one in April, one in August, Treasury bond in August, a 2025 July 3% Treasury note, a July 2024 Treasury note. A lot of the reason that that's kind of staggered out there like that, where it's front-loaded, a lot of it's maturing this year, but then it's got pieces kind of falling off, is to take away that reinvestment risk and take away any interest rate bets. So I'm not making any bets essentially on, well, I think now's a good time to buy. It's purely, it rolls off and it smooths out that investment risk. When you invest in a fixed income security, you really have three primary risks. And investing in a treasury note takes away one of those, and that's default risk. The other risk is interest rate risk. And interest rate risk is what is happening to the price of that bond as rates go up and down. Once again, I told the board earlier, the committee earlier, that if you buy at point A and it matures at point B, well, that takes away risk number two. Well, then the third risk and the final risk we need to worry about is reinvestment risk. And that's what are we going to do when these bonds mature? And so by only looking at them when they mature takes away the interest rate risk. Then by not making any bets and laddering it out, it doesn't take away reinvestment risk, but it diversifies it across multiple maturities.
So you got 300 accounts to watch after.
Yeah.
How do you do that? How do you go about that every day? What do you look at?
So that's a great question. I get into the office, and the first thing I'm going to check is cash accounts, and I'm going to make sure the amount of cash in portfolios. So I'll get a list of all accounts in their cash values. If they have over $1 nominal figure or over, say, 5% cash. And I'm going to go in and I'm going to figure out, okay, why? And then right now we're working on our equity strategy a little bit, though we haven't shored that up. We're thinking about, do we need to add international? Do we need to? But a lot of the equity strategies among our accounts are in buckets. You know, so we bucket them according to like accounts that have that same strategy. So when you manage account, let me take a step back. When you manage account, first you manage the strategic allocation, which is the mix of stocks, bonds, cash, and or alternative investments. So you have a basket of 60-40 stock bond accounts that I run. You have a basket of 50-50 stock bond accounts I run. You have a basket of some with alternative. You have a basket of some with higher cash reserves. So they get in these buckets, and we group them in the system based on that. Well, after we do that, then we group them across, okay, what is their equity model, essentially? What is their stock model we have them invested to? Because Banco ZK runs a set number of stock models. Now, with public pensions, it's a little different because you have a list of available investments. So it takes a little more creativity to make sure the investments fit what we think is
Are all
appropriate.
your 300 accounts public?
No, sir. No, sir. Very few are, actually. I'm probably no more than 20. A lot of them are
20 of
you mean public, you mean like people like you and I, or people like Texarkana?
local government accounting
I don't-
accounts?
I mean, that's a good question. 2025, Jeff, what do you think, total? Well, we've got some stuff through corporate trust too, that we help with the fixed income investment. If I were to give you an exact number, I'd be lying to you, but that
okay.
a dozen to 2 dozen, depending. The rest are either corporate, we have a diversified mix of trusts,
Understood.
of individual retirement accounts, of agencies.
I just don't want the public ones to get buried somewhere.
Yeah, not going to happen,
Okay.
but I appreciate that. I totally appreciate that. No, we're going to, really from a perspective on investment management, the two things that we need to look at this account is the level of international equities appropriate or emerging market equities appropriate, which is, they're international emerging have lagged domestic in returns by quite a bit, but there is a level of correlation where they're not perfectly correlated, where it makes sense to include them. That probably will not happen forever. Things come in and out of favor all the time. So right now we're going to review international exposure, make sure it's at a good place, and then we're going to review places that we can ladder these bonds out, because like he said, we want this to last as long as we can make this last.
So, but as that 17, these other two mature here in the next 6 or 8 months, you're gonna look at where you put that money, right?
Absolutely, yes, sir. And we,
And lower that percentage in cash and equivalent.
yeah, so current cash is 72,000. The equivalence part, yeah, we're gonna, you still need that there because it's a liquidity thing, you know, you're
Right.
still making payments with this, but, as long as we have cash going in versus cash going out, we need to look at stretching the maturities.
That's what we pay y'all for, to watch it. Thank
Yeah.
you.
Hey, I love hard questions, yeah, I mean, I understand you're doing your job by asking those. But no, it's, for a reference point, when I was at, my prior employer, I probably had 1,100 accounts, of them 700 to 800 were managed, meaning I was the only person that ran the investment strategy. Now, that was too much. It had gotten to be a bit much. Like, for instance, the day that, you know, off the record kind of, but the day that my son was born, on October 27th, I worked a 14-hour shift in the hospital with my laptop 2 hours after he was born at 3 o'clock in the morning to the end of the day. So, you know, that's the level of work is manageable here, if that's your question.
Sure.
Yeah.
We expect that of you.
Yes, sir. That's a true story.
Any more questions for Deb?
What was our total
Oh,
balance as of when you took over and
Let's go to-
as of December 31st?
let's go to the final page. I'm not sure exactly what it was when we took over, because I'm not, Jeff is more privy to that date. The final page is, that shows your balance today, which is $2,060,782. Now, the balance as of the end of the year was $2,110,694, but I'd be willing to bet that part of that is due to distributions, the decrease in account value. Because markets have been relatively flat to a little up since then. This relatively flat would be the right word to use there, probably. All right, I am done. Does anyone have any more questions? Because I would be happy to ask or to answer them.
You know, the longer you stand up there, the more questions I'll ask.
That's all right. I'll hang out. No, it's,
You get a supplemental report that begins September 22 and runs through the day of the report. We can run that, can't we, right? Or is it that?
yeah. So actually, I looked at running performance to the end of February, and I have a whole email chain with our performance reporting company about this a couple days ago. But it was going to be a standalone kind of choppy looking sheet. It wasn't going to be blended in. And I went, well, if it's an annual report, if there's anything you need, like performance from the beginning time to performance at the end of last month, be happy to get it to you.
Make you feel better, Ryder. I ask her a lot of questions too.
This is not the first time I've sat in front of a panel and answered questions on investments, and it's honestly it's a whole lot less pressure because I only took this account over a week and a half ago, so it's kind of a tongue-in-cheek joke there. But I do want to thank you all for your faith in Banco ZK. A lot of the reason you have faith in us is a lot of the reason that I moved my family with 4 days' notice back to Little Rock to be a part of something special. So, you know, I don't want that to be lost in translation.
Just take care of Texarkana, that's all we ask you.
Absolutely. Thank you.
Thank you. All right, that concludes the presentation from Banco ZK. Number 5 on the agenda is other business, if you guys have anything you want to bring up. No? Okay, and then the 6th item on the agenda is to adjourn.
All motion for adjournment.
Okay, I need a second.
Second.
Okay, and all in favor? All opposed? This meeting is adjourned, and it is 2:56. Thank you.